Okay, guys, may I have your attention, please? Our seminar is about to begin. Good morning, Professor Somya. Can you hear me?
Yes, I can hear you.
Yes. Okay. Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. Respectable, the head of Financial and Banking Economic and Study Program, Dr. Setio Wahyudi, but is not be able to attend this seminar. And honorable all lecturer of the economics department, and honorable all participants of this seminar. Ladies and gentlemen, guys, let me introduce myself. I am Faisal Fadli, the moderator of today's seminar. I'm very pleased to see you here and welcome all of you to this seminar. Today's seminar is about today's global financial and banking condition, issues and challenges, focusing in small medium enterprise finance. Well, ladies and gentlemen, our speaker today is Professor Masakazu Somiya. Wait, I will share the Professor Masakazu Somiya CV first. Okay, as you can see in the slide, he worked as an associate professor in Graduate School of International Development, Nagoya University, teaching macroeconomic, public financial management and finance. Also, he is an external advisor to development policy lending loans by Japan International Corporation for its project on public debt management in Jordan and Iraq. Moreover, he is an external advisor to a development policy lending loans by Japan International Corporation for its project on public management in Jordan and Iraq as well. He has, as you can see in the slide, he has about 19 reputable international papers that focus on finance and banking. Also, he has 36 research projects with the same focus. He also attend 9 international courses related to finance and banking. So Professor Somiya got his PhD from School of International Development, Nagoya University in Nagoya, Japan, and got his master from Economic Development University of Salford, Manchester in UK. Okay, before the presentation begin, let me inform how the presentation will be going on. First, Professor Somiya will be invited to present the material, and then after that, there will be a question and answer session and followed by a conclusion. Or if Professor Somiya allow, you can ask him in the middle of his presentation. Now, allow me to welcome the speaker, Professor Masakazu Somiya, to deliver his presentation. Professor Somiya, the time is yours.
Okay, thank you very much. So how long should I talk? What time should I finish my presentations?
About an hour and a half, Professor.
Okay, all right, thank you very much. I appreciate it.
Yes,
okay.
Welcome.
Thank you very much for very kind introduction by Professor Fari. My name is Masakazu Somiya. This is the second year to talk about finance in Bravija University. We have excellent PhD candidate, Professor Muiz. Muiz from your faculty, and then he's a very good friend of mine. So I'm very glad, I'm very honored to have this kind of opportunity to talk about finance in Indonesian universities. Okay, let me perhaps let me take 1 minute to introduce Nagoya University. Nagoya University is one of the 8 empire universities established 130 years ago, starting from a small law school and medical school. And then we have produced 6 Nobel laureates so far in physics and chemistry. International development, Graduate School of International Development, where I'm from in Nagoya University, is the first graduate school which focused on international development. And we produced about 20 World Bank staff, including me, and also about 10 to 20 United Nations system officials, including UNICEF and UNCTAD and UNIDO. So every year, almost every year, 1 or 2 graduate must be working in some way or another in international institutions. So if you guys, audience, are interested, please apply us, and then let's study together. Okay, let me take this. Then let me move on to presentations. Okay, let me share the slide. Okay. All right. Today, the topic is SME finance. This is one of the very important topics in finance area in developing countries. And then when I first came across with this topics, it was actually in Jordan. My first assignment at the World Bank was actually Jordan. So I visited Jordan something like 98 or 9. And then we visited many government institutions and private business institutions. And then at that time, 99% of companies in Jordan are SMEs. And then again, after I came back to Japan, and then I visited Jordan. The assignment by the JICA, Japan International Cooperation Agency, and the Ministry of Finance Japan to help to help Jordanian government issue government bond. So for that reason, I moved to Amman, Jordan, and then after 20 years, about almost 20 years, I again visited many government institutions and private business institutions, and I found out after 20 years, still 99% of Jordanian companies are SMEs, and then when we visit business associations, we of course, my question is why you have still so many. SME account for 99%, even after 20 years. Then many of the company associations and as well as companies told me that the bank doesn't give them loans. So that's the only kind of hurdle, they said, and then biggest hurdle for them to grow further. So I visited 25 banks, including some Islamic banks in Jordan. And then I asked why you don't give loans to them. And then they gave me 2 very convincing reasons, the factors. And then which later on I found out kind of de facto standard in even textbook of finance for SMEs. I'm going to talk about that too. They are first problem is actually financial statement. SME do not follow international standard of financial reporting system. that's actually how you keep your books, financial books. Um, Sorry, perhaps I should. So I'm very sorry about this. Okay. All right. So um, so you know, they told me, I mean, banks told me that their financial statement, in order to give loans, banks need to evaluate, make assessment on the credibility and the creditworthiness of the applicant firms. But all the document prepared and submitted by applicant firms to the banks are not well organized. And they know, some of them, banks told me, many of them have a very good business model, but they couldn't verify good business model with document, so that in order to convince their bank executives to give the loans to SMEs. So that's one of the biggest hurdles for banks to give loans. And another reasons they told me in case of Jordan is actually there's no collateral. Okay. In many countries, I guess including in Indonesia, for big companies, banks, commercial banks do not require to submit collaterals, but they do make more assessment, evaluation of the company financial status. Yeah. But for SMEs, in many countries, banks require collaterals. And what are the collaterals? I mean, what are the source materials of collateral is actually land, usually. Then the problem in Jordan is, okay, in many cases, SME do not have a collateral. If they do, but it's maybe very small, it doesn't cover adequately for the loans. And then in case of Jordan, they don't, the problem is actually more deep-rooted. That is actually, they don't have a, Jordanian government doesn't have a cadastry. That is actually a land depository database. Yeah. So, so you want to check, I mean, you want to investigate the collateral, you go to the city hall maybe, and then look at the cadastry, and then find out who is the owner, and then who is the size, and then, you know, who is the location, what is the location, and who is the owner, and then what is the, yeah, where it's located. Yeah, but I mean, in case of Jordan, city area they have, but in the countryside, I mean, even suburb, they don't. And one of the biggest reasons for why they don't have a cadastry land depository system for suburb and the countryside is actually they don't have an address. So they don't have no address, so that's why actually no way to verify the owner of the land, which can be a collateral. So that's the reason why they cannot put up the collateral. They means actually SME. SME cannot put up the collateral to the commercial banks because of because there's no cadastry system to verify the owner of the land and then the location of the land and the size of the land. So that's how I get interested in this SME finance. Okay, SME. Okay, move on. All right. What are SMEs? Small and medium-sized enterprises are non-subsidiary independent firms that employ fewer than the given number of employees. The definition is here. Okay, let me check. So by RSA, Republic of South Africa, the small firms is defined by employee less than 50, and the medium-sized enterprises defined by employee number 200, less than 200. EU 250, US 500, Australia 200, World Bank 300. In case of Japan, it's 250. This number varies across countries. The most common upper limit for SME is actually the 250 employees. So then SME in many countries account for 60% to 90% of total employment. Then SME also account 40% of national income in emerging economies. Many SME remain informal. Data on informal SME are very hard to find, and it is safe to assume that if the data on informal SMEs are included, statistics illustrating SMEs' importance to the economy would be even much higher. Okay. All right, and then development of SMEs. All enterprises start small. And then at the early stage in their development, many of them are informal, and then they primarily internal. They primarily use internal fund. The owner and their family and friend, they borrow. I mean, the owner of the small SME borrow from their family and friends and relatives. That's usually how all enterprises start in the countries. But eventually, in order to grow, SME will move to formal sector and need external funding. And if you remain informal, there's no access to external funding, which means actually bank funding in many countries. They need external finance to grow, invest, and acquire new technology to increase productivity. Without financing, they may not be able to expand to compete in regional and the global market, or even establish business linkage with larger firms and position themselves in the value chain. Particularly, being formal sector is crucial if the company is interested in exporting, because when you export or maybe you import, you need a trade credit extended by the commercial banks or maybe national exim bank, export-import banks. So to be qualified for trade credit, you have to be formal. So okay, this is a data for SMEs. Then the bar chart, the bar on the left-hand side, total number of SMEs, formal and informal. Second bar from the left-hand side, the number of SMEs with checking account. The second bar from the right is the number of SME with loan and overdraft. So it's some kind of borrowing contract. And then right hand side, I mean the bar on the right hand side is it's actually the number of unserved and underserved. So those SME who have no access to finance. If you look at the East Asia and Pacific, we have because we have China. That's why actually denominator is huge. But even considering that, we have lots of SMEs and also lots of SMEs and lots of SMEs with out access to loans. All right, South Asia includes huge population countries like India, Pakistan, and Bangladesh, but look at their number of SMEs with unserved and underserved. It's 36 millions, while East Asia 96 millions. So that tells how short our bank loans available to SMEs. Okay. So size matters in access to finance. One of the most defining features of SMEs is its size. SMEs are small. Does that affect their financing opportunities? Yes, it certainly can. Financial intermediaries, that is commercial banks, play important roles. They reduce information asymmetry and have comparative advantage in obtaining information about borrowers. And accomplishing this is easier and less costly for large, transparent firms. Okay. Of course, financial intermediary are important for SMEs, right? And then what is information asymmetry? This is the amount of information available to lender, which is banks, and the borrower, which is SME, is different. Well, exactly what I mentioned. This is exactly what I mentioned in my experience in Jordan. Bank claims that SME cannot submit well organized financial statement. So they know SME knows them by themselves a lot, but they have a weak communication capability to talk with banks in order to convene their information, all the information they have to the banks. So banks has less information, but applicant have lots of informations. So this is called information asymmetry, which is one of the very few common notions in analyzing financial sectors. And then, all right, why this is different from large corporations? Large corporations, the information are everywhere. You don't have to call, you just Google it, and then you get lots of information on large companies available on the web, right? So the information asymmetry is actually very small between companies and banks, while it's very large between SME and banks. Large firms offer the economy of scales, and small firms do not. As a result, banks often consider SME business too costly. SME lending require more staff to disperse smaller loans compared to loans to large corporations. Furthermore, banks need to spend additional resources to provide their staff with the necessary skills and knowledge to deal with SME lending. Okay, in order to disperse or in order to make assessment, or the number of staff who make assessment for one company is the same. But what if, let's say, Toyota borrows maybe $100 million, right? And then interest rate is 1%, which means 1 million. Banks get 1 million, right? But what about SMEs? They borrow $100, and 1% is $1. Banks has to allocate one person to assess and to assess. But for large companies, they get 1 million, and as for small SMEs, you get $1. So for this reason, SME lending to SME is very, very costly in view of the banks. That's why they need, and then so that's why actually they prefer lending to large companies. Another one, lack of internal funding. Oh, of course, a big company has a lot of funding, internal funding. So that's why they can use their fund for investment, while SME doesn't. Information opaqueness. This is similar to information asymmetry. Corporate and larger enterprises are usually able to provide audited financial statement and have several years of financial and operational track record. This allows a bank and an investor to conduct financial analysis and make a decision based on information that they trust. In some cases, there are also rules and regulations that makes it difficult for banks to lend to companies that are not registered. Of course, banks need a registration, a formal. Banks need their customer to be in formal sector and registered at the government or city hall. Yeah. Why? Because when they don't pay, how can we identify them, and how can catch them? Yeah. So when they don't pay back, when they are in difficulty to make a repayment, banks has to ask them to repay by legal enforcement. So for this reason, customers for the banks has to be, so borrowers of the bank has to be in formal sectors. Okay, and all right, so let me move on. SME, however, are often unable to or are unwilling to provide sufficient, accurate, reliable information to financial institutions. That's what I means they cannot submit and prepare the financial statement well organized and consistent to international, accounting rules of the countries. They typically cannot provide transparent and audited financial statement that banks require. And the statement they can provide are often non-transparent and sometimes unreliable. This creates what is known in economics informal asymmetry. So, SME knows themselves 100%, but their lack of the communication capability to talk, to give 100% of information to banks. Okay, information asymmetry. Maybe by now, you may know. Banks doesn't have the access to all the information that the client knows about the business, her business. It is highly likely that at least some relevant information is known only to the client. This information asymmetry can and often does prevent the lending transaction from taking place, since all parties involved in transaction do not have access to all information that they need for their decision-making processes. This information asymmetry therefore becomes the most serious obstacle for SMEs to obtain credit from formal financial institutions. This informational opacity is further aggravated if an SME operates in the informal sector. Okay, SMEs and the informal sectors. Large side of informal sector is often associated with high cost of formality. For example, cost of verification of property right, the cost of filing taxes. Why companies stay informal? Because they don't want to spend a lot of time to register sometimes their properties. And then sometimes it takes maybe 10 days, 2 weeks, or 1 month to pay tax. They may have money to pay taxes, but they don't want, because if they spend maybe 10 days for tax, just paying taxes, they can work and then earn maybe so much money, $100 million, $1 million maybe, or $100,000 for 10 days. So they don't want to lose their profit while spending time for taxations. These costs tend to have a stronger adverse effect on SMEs because they are less likely to be able to afford those costs than large enterprises. So it is not surprising that countries with large informal sector usually have more predominant SMEs. Well, that's the case for developing countries. In order to grow, SME need to obtain finance. To do that, they need to provide reliable financial information to lenders. But to do that, they need to be in formal sector. But that's being formal sector is costly because, all right, they have to pay, in addition to tax, they have to pay staff's social contributions, social contributions, social welfare contributions, or unemployment benefit contributions, and pension contributions. It's a lot. So that means actually they pay less to workers or staff than in being in informal sector. Informal sector, you have to pay social welfare contributions and pension and unemployment benefit contributions. While if you are in informal sector, you don't have to. Okay. In some cases, this situation can be further compounded by special reporting regime for SMEs, which becomes additional incentive for them to stay small. For example, when reporting requirements are lighter for small enterprises, or when it's easier to avoid taxations when you are small, enterprise may prefer not to invest and grow, prefer being small. They would rather stay small to avoid reaching the threshold where regulatory burden become more onerous. So let's say if you are medium-sized enterprises, you have to pay maybe pension. But if you are a small enterprise, you don't have to. Then you try to maintain your staff up to 50, no more than 50. If you have if you hire one person, 50 first person, then you have to pay pensions or social welfare benefit because they are you are categorized as medium enterprises. Okay, why SME have less access to finance? There are many reasons why SME may not be able to get financing from financial system. They include lack of project with positive net present value that would justify bank financing. Okay, the criterion to borrow and invest in project is the equation in red color. The total, net present value, which is actually each year's capital inflow revenue, each year's revenue divided by 1 plus interest rate raised to the t's power. All right, your project has a 2-year life, and the first year you get 50, and the second year you get 50 cash inflows, right? First year, no problem. The second year, you can, first year, 50 divided by 1 plus interest rate, plus second year inflow, which is 50 divided by 1 plus interest rate squared. So this is net present value of future cash inflows. And then you borrow the money. And then if your repayment, net present value of your repayment denominated by the interest rate to the corresponding years, if that repayment, net present value of repayment is lower than net present value of cash inflows, you are qualified. I mean, you want to borrow, right? But for this kind of project, which has a higher net present value of cash flows than repayment, net present value of repayment. There are not many projects like that for SMEs. Second, lack of management skills, and they are interested in expanding their business. Sometimes they prefer being small. Third, natural limit to the size of an enterprise or optimal size for some industries. Some industries like garment, maybe better to be small. Well, that may be optimum size of the company, maybe small in some industries, like a garment, yeah, textile. While it could be large in maybe car industries or computer industries. So sometimes because SME operate in labor-intensive firm, business. So that's why actually their minimum, optimal size may be small. That's why actually they don't have to grow. Lack of collateral, that we already argued. Complex application procedure to get the loan. Banks give lots of procedures. You have to, submit maybe hundreds of pages, something like that. Then you don't want to. The size and maturity of the loan are not sufficient to meet their need. Sometimes, they want to borrow 100 millions, but banks only give 10 million. Then also, banks, you can afford maybe 5%, but banks offer maybe 8%. So the terms are not convenient for applicant. But these reasons are not necessarily an indicator that something is wrong in terms of commercial banks or maybe SMEs. There may be a good justification why banks are not offering SMEs the terms of financing that they want. But they should make us take a closer look at the issue of SME finance and ask themselves a question. Is there evidence of market failures? If the market is failing to give the loans to SMEs, then maybe we have to fix it. Or this question is those reasons why SME have less credit to finance, less access to finance, may be reasonable. That's the question we are asking. Are these SME out there that have sound bankable project that do not get implemented because of lack of finance? Okay. Okay, they have so that means actually they have a good business model, but they couldn't implement it because of the lack of finance. So banks is not doing their job. In that case, we should think of what can be done to overcome the obstacles. But we have to remember the goal is not finance for every SMEs. That's why directly lending and subsidized interest rate for SME are not the way to go. Okay, let me ask you guys some questions. All right. What's the problem and the consequence if those SME who are not credit worth get credit? So my question is actually, what are the problem if banks give loans to the company which should not be given the loans? Okay, let me ask some of you, perhaps. Okay. All right. So, all right. Anybody who wants to talk?
Okay, guys, you can raise your hand or write in the chat the answer. So maybe please, Professor Somya,
Okay.
can you
Thank you.
show the question again?
Okay. What is the problem and the consequence if those SME who are not credit worth get credit? What if the banks give credit to the SMEs which shouldn't be given the credit? Yeah. What are the consequences? Perhaps let me ask somebody. Maybe you are okay. Or maybe okay. Ahmad Lutfi, Mr. Ahmad Lutfi.
Okay, Ahmad Lutfi. You can answer the Professor Somya question.
Oh, okay. Yeah, yeah.
Or you can answer in Indonesia. I will translate it to Professor Somya.
Thank you. Appreciate.
Oke, guys. Jadi apa yang akan terjadi ketika ya bank memberikan kredit kepada SME (Small Medium Enterprises) atau UMKM yang kalian ketahui ya. Apabila UMKM itu nggak capable untuk bisa balikin dananya. Kira-kira apa yang akan terjadi?
Thank you very much, Professor Fadi.
Yes, you're welcome, Professor Somya. Is there any want to answer?
Okay, what about Kevin? Kevin Lahang Sunjaya? Oh, okay.
Okay.
Okay, we have
okay, from Devana Fadzila Rohman, Professor. She said that bank will collapse and the bank will facing the default.
Yes, exactly. Good, good. Thank you very much, Davana. Thank you very much. Appreciate. Yes, you're right. Yeah, yes, you're right. Okay. If banks give loans to the company which has a very bad business model, this company, after they borrow, after the money is dispersed, this company will not be able to pay back next year. Yeah, and then what's the problem? The problem is actually the banks do not lend the money of themselves, right? The money banks lend is coming from the deposit of the depositor, who are you guys, and including me. And then, you know, I deposit trusting 100%, the bank's 100%, and then, you know, maybe this deposit I'm saving because I'm going to use saving after my retirement. It's very important. But if banks give this money, lend this money to someone who cannot make a repayment, then, you know, money is gone, and then I'm gonna lose my money for after retirement. So for these reasons, banks has to be very, very, very careful about extending loans, checking the business model and credit worthiness. So if the customers are not credit worthy, it's actually right. Banks shouldn't give loans. So, you know, from the point of view of SMEs, you know, banks which gives loans to SME regardless any situations is good banks. But in terms of economy-wise point of view, banks who give loans to the right SME are good SME. Banks which who give loans to anybody are bad, actually, banks. Yeah. So we shouldn't be mixed with you know, the view from lender, borrowers, and then view from economic justifications. Okay, let me move on. Okay. All right. So the goal is okay. So all right. So maybe all right. So this is why direct lending. Direct lending is actually okay. Um, um, many countries, including Japan, have national, government-funded banks. Yeah. And then a government-funded bank give loans to the customer which government wants the banks to give. So that's kind of directed lending. Yeah. And then in many cases, what happened in Japan is actually, okay, from the government viewpoint, this company is very important for the Japan. So banks, national bank has to give loans to this bank and these companies. But government is amateur. They are not really, they don't have a skill to make assessment about repayment capability of the companies. So very often, government government order national banks give loans to the company which are not credit worthy. As a consequence, this company go into the bankruptcy, and then deposited money are gone. Yeah. The same as subsidized interest rate. Okay, sometimes national bank give lower interest rates to companies than market rate, yeah, because of political considerations. But in that case, maybe that's not actually justified by from the economic viewpoint. The purpose is to create an enabling environment, but that we mean an environment that would facilitate financial institution lending to SME that have valid financial need despite obstacles such as information asymmetries. So banks has to be very careful. Giving loan is not that always good idea. Okay. All right. So these factors, I'm showing the factors that are important in lending. How reliable are financial documents provided? Can they be verified with the credit bureau or other sources? Credit bureau is crucial in lending. Why? Because when commercial bank make a give loans, before that they have to make assessment of the companies, right? And then perhaps banks have information about this company from their bank account, credit account, bank account, yeah, transactions. Let's say how much money, how much cash inflows they have. They means actually companies. How much inflow the company has, or how much is this company paying every month? Yeah. If the money is flowing in to the bank account $100, and then company is paying maybe $50, okay, every month. So their cash benefit and profit is $50 per month. Right? Okay, but another companies is they are receiving $100 million, and then they are paying $50 million. So their net bank balance is actually 50 millions, right? So this is huge difference. So they have information, but normally banks have, company have lots of bank accounts in different banks. And then, so credit bureau is actually public institutions which have a database for credit history of the companies as well as people. I mean, per individuals. Because SME, the owner of the SME and then president of the SME are usually individuals. Well, founders of the companies, and then most of the money, the asset and the money are coming from actually their personal asset as well as capitals. So this credit bureau have the not only company but also individuals' credit histories, including Masters and Visa credit card, as well as the payment history of power or water and maybe gas. These payment informations, consolidated payment information for particular country, companies and the person is very important, and then very, very helpful for banks to make an assessment, credit assessment. Technology is information about enterprise available online and in real time or only on paper sources. All right, of course, information regarding the company, if information available online, it's more transparent. So that means actually transparent means actually banks have less information asymmetry, and then banks has more information. Is the information up to date? Yes, this is important. Sometimes in case of Jordan, the financial statement submitted by the company is very old. No, it's not reflecting up to date informations. Market structures, how competitive is the industries where enterprise operate? How profitable are enterprises in that industry? And then other banks lending to similar enterprises? Okay, banks has a lot of customers in the same industries, so banks can compare the applicant borrowers with other companies in the same industries, based upon their bank account, right? So in this way, they can make a credit assessment. All right, and then sometimes they banks talk each other, particularly credit informations of the companies, and because they are helping each other. Okay, and then legal environment, can contractual obligations be easily and quickly enforced? Legal enforcement is very important. How easy is reprocessing collateral? Okay, this is very important in many countries. All right. Okay, one company go into bankruptcy, and then banks have a debt. Credit. How can I say? Financial obligations. Bank has gave loan to this company some time ago. So bank is in trouble to collect their money. Yeah. And then normally when the company go into bankruptcy, their asset actually marketized, which means actually the lawyers or sometimes city government or national government sell the asset of the company which went which goes into bankruptcy, and then they sell in auctions, and then in this way they can get the money and then give this money to banks or creditors. If it takes time, maybe 10 years to collect the money from the selling asset of the companies, then banks will be short in terms of cash. For this reason, maybe sometimes banks may go into troubles. So quick reprocessing of collateral is crucial. And then sometimes by law, financial obligation cannot be observed. Law enforcement is weak sometimes. In that case, even you borrow from the banks and you don't pay back, but nothing will happen. Well, that always, it's sometimes happens. Okay. Then let me move on to lending technology, which is actually, what time is it now? All right. Okay. Okay, I have 40 minutes. Okay. Let me move on to lending technology. Lending technology is a unique combination of primary information sources and the screening and the underwriting policy, procedure, loan contract structure, and monitoring strategy and mechanism. Let's move on. Primary information source is actually collaterals, and then information by yourself. The collaterals means actually land and the building and yourself. If your annual income is high, then it gives good informations. But if your income is low, then you are not very creditworthy. The second, screening process. It's assessment, credit assessment, including income. But again, loan contracts, loan or credit line. All this information would then determine loan contract that the financial institution would offer. Maturity, interest rate, and side of the loans, right? And then loan contract, the banks offer mainly two kinds of financial products. Loan that actually you get a $1 million loan, and then so which means actually after contract, $1 million is disbursed to you, and then repayment period is something like 3 years. So next year on, you pay 1/3, and second year 1/3, third year 1/3, with interest rate. Interest rate depends on the credit worthy of your companies. If your company is large and the business model is good, the financial statement is brilliant, then your interest rate is low. But if your company is small and then it could be everybody has a doubt about your repayment, then perhaps you have to pay high interest rate. And then, so loan is you receive disbursement uploaded, front-loaded. But credit line is not like that. Credit line is, okay, let's say I give you $200 million credit line. That means you don't have to borrow $200 million. But $200 million is always available for your use. Yeah. And then maybe first year you don't have to borrow anything. But second year, maybe financial crisis takes place. So a company withdraw 100 million from this credit line. Company wants to have a credit line if they have a huge uncertainty in their business in future. And then for loans, is more suitable for project. All right, you have a maybe you want to build factories. So for this reason, you borrow loans. Yeah? Because in order to build a loan, I mean, in order to build a factory, you need lots of money front loaded. Yeah. But credit line is more like a working capital, the use of for working capital. Let's say because of financial crisis happens and then no export or no sales, but still you have to pay to your staff. So in that case, you are short of the cash maybe. In that case, you borrow. And then it takes time to make a loan, to come to the to complete loan contracts. But credit line, once you have a credit line already, I mean credit line contracts, then for corresponding years, let's say 3 years of credit line to up to $200 million. So from today and next year, 2 years later, 3 years later, so up to maybe 2014, I mean 2024, anytime if you want, when you want, you can borrow up to $200 million. Yeah. So so the purpose of your financial need, depending on the financial need of the purpose of your financial need, you choose what banks offers, loans or credit lines. Of course, you need a regular monitoring, which is part of lending. All right, and then in terms of lending mode, we have two mainly two lending mode. One, relationship lending, another one, transaction lending. Relationship lending is based on soft information about borrowers. Soft informations such as characters of managers or how staff work, how long they work, or how clean the office is maintained. These kind of not hard information like numbers or of the bookkeeping, yeah, a financial statement, not like that. But you don't know, you have no idea when you are the office, bank office. You have to visit the customers and then see what's going on in the companies. Then you know you get the soft informations. All right. Soft information is easy to understand when thought of as the opposite of hard information like a financial statement or capitals. It is often qualitative and cannot be easily verified, stored, or transmitted. In order to collect such soft information, a financial institution must have a close relationship with the borrowers. Such a relationship allows a financial institution to understand borrowers' businesses, its prospect, and to determine whether projects that require financing are bankable or not. Relationship lending is typically used in case where hard information about borrower is not available, making transaction lending unfeasible. Okay. Relationship lending is very often considered to be the lending technology most suitable for SME lending. SME informationally opaque. It's very hard to get the information. I mean hard informations. They typically cannot provide reliable and verifiable information about themselves. Relationship lending circumvents this problem as it doesn't require hard information about the enterprises. Instead, it requires soft informations. Relationship lending is not easy for financial institutions when executed properly. It requires a great deal of effort to obtain information about borrowers, understand its financial need, design the right type of loan, assess repayment ability, then monitor loan performance. So relationship lending is actually something like this. Bank official visit many companies, maybe regularly, maybe once per week or once per month, and then 2 years, maybe 3 years, 5 years, 10 years. So the relevant information about this company has been accumulated in these banks, other than bank account. And yeah, so based upon this software information, bank make a decision to extend loans to this company or not. Relationship lending, initial customer investigations. How to obtain information? Information will be obtained by the so-called relationship officers. Yeah. So this is the bank officer who visit companies regularly. They will be in contact with the potential borrower from the beginnings, evaluating the location and appearance of their premises, presence or absence of competition, and the relation of the owner, manager, and the staff. Right? And then financial details, banks and trade references from the owner, manager, various information from credit bureaus, if they exist, various non-financial information from business partners, business associations, and chamber of commerce. These are the where you get the soft informations. Assessment. The financial institution then assess the stated purpose of the loan and whether the amount requested correspond to the stated purposes. They will verify the planned cost of investment proposed by the customer is reasonable or not. They will also take a preliminary look at the cash flow pattern to determine the most appropriate loan term and the repayment schedule. In some cases, a financial institution may already be familiar with the industrial sector where the borrower operates. If not, they will have to learn. Well, in many cases, this relationship officer visits many companies, some of which may be operating in the same industries. So in this way, comparing two companies in the same industries, relationship officer have a good idea to make assessment of two companies in terms of creditworthiness. Yeah. Okay, relationship lending number 3. Understanding sector production process and product cycles. Sector analysis is the basis for understanding how the borrower's business compares against the best practice in the sector. So you can compare, the relationship officer can compare with some of her customers in the same industries. But then they have to understand the production process and the weakness and the strengths of the business. And they have to understand the business cycle. I mean, not business cycle, product cycles. What is product cycle? Product cycle is all right. Let's imagine the chart. The horizontal line is years, and then vertical line is the sales. Yeah, when you invent and then when you start producing a particular product, like let's say car, nobody knows. So production is almost zero, but as time goes by, production gradually goes up. Maybe maybe sometime later, production and the sales hit the top. But after that, maybe 4 or 5 later, maybe other new cars are coming out to the market. So people start shifting, buying your car to buying another type of cars. So sales gradually goes down. Yeah. So this is at the initial stage of their development, the sales is small, but in the middle it hit. Then later on, their business sales is going to be so like this. Initially, it's 0, but gradually goes up at the top. Then you gradually go. I mean, the sales goes down. So when is a nice time to give loans? You know, you don't want to give loans at the end of the product cycle, right? You know the sales is going to be shrink year by year. But in that case, you don't want to give loans, right? You give loans maybe before the top. Yeah. So you have to know where in the product cycle is your customer is operating. Okay. And then SWOT analysis, it's it's more like a kind of a normal practice by the banks, any banks. You have to make assessment on the strengths, the weakness, opportunities, and the threat. This is called SWOT analysis. Yeah. Okay. All right. And then relationship blending, assessing management skills. Okay, maybe I mentioned in many cases, the owner of SME is a founder, and the manager of the SME is a founder and the owner. So, and then they or she or he is going to manage the company for a long time. You know, when they are young, owner and the founder establish the companies, they operate until maybe they retire, maybe 40, 50 years. In big publicly limited companies, the president is actually changes. President changes every 5 years or maybe 10 years. But in SMEs, president or the CEO stays forever. So you know that it's very important to make an assessment on the managerial skills of the owner and also COEs. Okay, and yeah, let's move on. So this is the kind of stage area chart for lending loan to SMEs. Initial customer investigation, assessing customer needs, understanding sector production process and product cycle, SWOT, and then assessing management skills. Okay, let's move on. All right. Yes, as I said, relationship lending is suitable for SMEs rather than transaction lending. Okay, because transaction lending, they extend loans based upon the hard numbers, capitals, asset, collaterals, you know, and then profit. Those numbers trustable. You can trust because if the number are coming from big company because it's transparent. Yeah. But numbers cannot the number hard information about companies like income, sales, the capitals are relatively limited for SMEs. For this reason, the relationship lending, which use soft information like character of the president or you know the relationship between employees and the employers. This kind of soft information, using this kind of soft information, banks make a decision to extend the loan. That's called relationship lending. Although relationship lending does circumvent the informational opacity problem, it may not always be easily executed. Relationship lending involves significant effort to obtain reliable soft information on the borrowers. Not surprisingly, many financial institutions find it difficult to bear the cost of full relationship banking services. Those who do provide such services find it more cost efficient to devote these efforts to a large customer than a small one. Of course, even in this relationship lending, maybe lending, giving loan to big customers is more profitable and more cost efficient. Okay, and then relationship lending can solve the problem of information asymmetry. However, it's costly for financial institutions, most of whom who would be reluctant to bear such costs in order to provide loans to SMEs. Okay, let me move on to transaction lending. Okay, this type of lending is based on hard information about borrowers. For large firms, the choice would be between building a banking relationship or simply seeking a loans on a one-off basis from transaction lenders. Okay, the latter is often simpler, especially in the case of standardized loans for specific purposes. Okay, so transaction lending is also divided into two. The one with relationship and another one without relationship. The typical lending, loans for latter case, lending with transaction lending without relationship is actually housing loans. Okay. Yeah. Okay. So housing loan, I also have experience. They don't look at the character of the borrowers. They just look at the numbers, hard information, and then just kind of automation system to come to decision making. Then they have a lot of criterions, and then we give numbers on these criterion, and then computer is going to process it and then give us a loan, decision if I'm qualified or not. So you don't have to spend a lot of time. As I said, downside of relationship lending is actually it takes time, and then the cost inefficient, right? But you don't have to allocate many people. Just let website handle the request for loans. So so this is actually typical transaction lending for housing loans. All right, it's a financial statement lending. Banks rely on financial statement to provide accurate, readily comparable information to assess the profitability and the value of a business. And the financial statement are also used to assess liquidity, cash flows, leverage, and overall solvency. Okay, leverage means all right. Okay, you usually let's say, all right. So let's say in case of housing loans, all right, you have a $50 million, right? But some people you get the loans for 100 millions. Yeah. Some people you have a 20 millions, but also she get 100 millions, right? The first one is loans 100 million divided by your deposit 50 is 2. The latter case 100 million loans divided by your deposit 20 is 5, right? 5 is higher leveraged. The latter borrowing is called high leveraged loans. Yeah. So all right. Usually in Japan, you want to buy the house which is $100 million. Yeah. In that case, you should have at least $30 million. Yeah. But let's say if you have a good credit histories, then maybe you don't have to have a 30 million. Maybe you can only have a 20 million, and then you can get $100 million loans. But if you have a good credit histories, you can have a high leverage loans. Okay, and solvency. Solvency is the capability to make a repayment. So our financial statement tells you the capability to make a repayment. If your loan to borrow is $100 million and you pay back 5 years, every year you have to pay $20 million, right? But what if your profit is $5 million? You're not solvent, which means actually you're not capable to make a repayment to your overall loan, $100 million for 5 years. All right, financial statement lending is adequate for relatively transparent firm with certified audited financial statement. Applicant auditor must be experienced and entrusted by the banks. So, if your company executives, owner or founder, you always have auditing, accountants auditing. It's going to help you when you apply for loans. Credit scoring. All right. This is a typical, very popular way of lending. Some types of transaction lending can be used for small, informationally non-transparent firms. For example, lending based on the small business credit scoring is one method that can be used for SME lending. This lending technology does not rely on financial statement. Instead, it uses hard information on SMEs and its owners, which can be obtained from other sources, including consumer credit, commercial credit bureaus. So, from bank's point of view, variable corrected correlate with borrower's creditworthiness. So the banks collect information on how old is the owner. Yeah? If the owner is young, then you can pay back. If they are in troubles, they can make a. They live long, so they have more time to pay back. But if the owner is maybe very old, then it's very difficult to pay. Yeah. So they have a set of variables in order to come to a conclusion for decision making. Most of the information are based upon consumer credit and commercial credit bureaus, and then automatically, if you give the information data, then credit decision is automatically made. Okay. And the idea is to obtain most objective and accurate forecast of the borrower's creditworthiness. Scoring is a self-learning system that allows for more accuracy in forecasting than a single loan officer can guarantee based upon her personal experience. All right, perhaps we may move on this scoring system. Okay. Okay, maybe we can move on. Okay, so we have 3 other lending. Asset-based lending. Well, this is asset lending decision is made based upon asset, including fixed and financial asset. But fixed asset lending, this is more like a more used for SMEs. So the collateral is fixed asset, building and land. And the cash flow lending, this is the lending decision is made based upon future cash flows. Okay. Perhaps I should let me talk about credit guarantee schemes. This is very important for developing countries. Yeah. Okay. One of the problem in developing countries in terms of access to loan is, as I said, okay, SME cannot provide well-organized financial statement, and the SME have no collaterals, right? Then banks do not have cannot make a cannot take high risk. Why? Banks cannot take high risk because their financial resources are coming from deposit by the depositor who believes, trust 100% banks. And then if banks make a if banks go into bankruptcy, the problem is much larger than the ordinary company, companies. Yeah, you know, why? Because okay, Toyota go into bankruptcy, right? So maybe banks will be in troubles, but not many other companies. But banks is in troubles. Then, as you may guess, so many depositors have a deposit at that bank, right? So they rush into this bank to withdraw cash, right? So, and what is the consequence of bank? This situation is called bank run. Run means RUN, because people rush and then run to the banks to withdraw some cash as soon as they know your bank is in troubles, right? It's called bank run. The problem and the consequence of bank run is rooted in the special functions of the banks. Okay, what banks does is banks give loans, maybe $100 to company A, right? And then, as you know, this $100 is not spent one day because company or this company A use this $100 to build factories, right? It takes maybe 1 year. Let's maybe 3 months. Let's say 1 year, right? So over the 1 year, $100 is used, right? Let's say 6 months later. Okay, let's say 1 month later, they use only $10 out of $100. So this company A deposits $90 at the banks, right? So initially bank had $100 and then but $90 are back to bank account, right? So bank has $90. So again, this bank give loans to company B, maybe out of 90, maybe 50. Okay, and then 50, right? But as just like company A, company B does not spend all the 50 disbursed in 1 day or 2 days. They use maybe $10, and then the rest, which is actually out of 50, they use $10, which means $40. They put at the bank account. So now bank has a $40, and then bank lend this 20. Out of 40, they give 20 to loans to company C, and then she doesn't spend everything. She put the company she put the money $10 at the banks. So right now banks has a 30 cash, right? But look at the loans. First, company A $100, and then company B $50, and then company C $20. So bank's asset is $170, and then they have a $30 in cash. Remember, bank started at with $100, right? So All right, then someone says this bank is in troubles. Okay, in that case, bank run happens. Everybody, well, this bank, I mean, the guy who has $100 at the bank, he comes or she comes and then say, I'm going to withdraw $100. What happened to the banks? Banks has only $30, right? But they cannot. So that means actually um, uh, this bank is going to ask company A, B, C, please return everything to me. Yeah. So then, in this way, okay, in case of Toyota going into bankruptcy, the problem is limited. But in case of bank going into bankruptcy, problem is huge. It's not limited within the banks itself, but many borrowers have to suffer from the troubles in the banks. Yeah. So banks has to be very careful. But for the economy, it's important to mobilize banks' financial resources. So for this reason, many countries have a credit guarantee schemes, which is backed up by the government. Yeah. Credit guarantee scheme, CGS, is usually a standalone entity with a mandate to encourage private sector to lend to a specific segment of borrowers by providing partial guarantees on loans that promise to refund a private lender partially when a borrower from that specific segment defaults on their obligations. CGS may target SME operating in specific industries or cover all SME types. So, I'm sorry. Okay. All right. It's operating is okay. So all right. The problem of the SME is actually they are not creditworthy, right? Okay, SME want loan $100, but based upon their credit histories or financial statement and collateral, they are creditworthy for only $50, right? And then but this CGS said, hey, okay, they are not creditworthy for $100, but we can guarantee $100, I mean $50, so that banks can give loans $100 to these companies. So this is the system. Okay, and then this guarantee is usually provided against fee covered either by the borrower, lender, or both. In case of default, lender is usually obliged to proceed with the loan collections and share the proceed with guarantors. Thus, credit guarantees allow the partial transfer of credit risk stemming from loan to or a portfolio of loans from the lender to guarantors. Recently, as CGs have become very popular to help foster credit for SMEs and are present in more than 100 countries. Yeah, well, it's more than that now. CGS have become so commonplace that an OECD survey of such arrangement qualified them as a structural element of financial systems. Many national and multilateral development banks also offer similar schemes. Okay, let me introduce another one. Okay, let me. Oh, sorry. All right. Maybe. Oh, sorry. I'm sorry. Perhaps should go back. Okay. Yeah, this one. Okay. Let me talk about factoring, I guess. This is also a very powerful tool for SME finance. Oh, sorry. Where is it? Okay. I'm sorry. Let me have another 5 minutes to talk about factoring. Where is it? Okay. Okay. Factoring. We don't have it. Where is it? Okay, I'm sorry, I cannot. Okay, let me summarize maybe CGS, and then I'm going to mention briefly about factoring. Okay. Okay. So credit guarantee system looks very good, right? But the main argument is pros and cons on CG is that this scheme can address information problem in the long run by acting as a subsidies for financial institution to cover the initial cost of learning about a particular group of borrowers. All right, because CGS guarantee is very frequently used the loan by the banks to the customer for the first time banks give loans. Yeah. So, and then in this case, SME, well, private financial intermediary might lack incentive to incur upfront costs of learning about new borrowers and devising the required lending techniques. So, so actually, if the credit guarantee system is available, then banks do not try to learn about new borrowers, right? And then another downside is actually, okay, what if the company which have loans with credit guarantee system go into bankruptcy? Yeah. So company borrows $50, $100 from the banks, and then $50 guaranteed by CGS, which means this means when the company go into bankruptcy, then this credit guarantee system has to pay $50, right? And then this is public institution, which means who is going to pay is actually taxpayers. Eventually, taxpayer pays $50 if credit guarantee system fail to collect the money. Yeah. So that's another downside. Okay, let me talk about factoring. Factoring is very, very popular in the United States, but not in Asia so far yet. Factoring is actually, let's say, all right, okay, this is what happened in the United States. All right, I was in Washington, and then I had a long missions to Jordan. I stayed a couple of months, right? At that time, my electricity bill and the telephone bill and the water bill, they are not paid. It was not automatically wired from my bank account. And then because my bank account was actually zero, because I changed my bank account. So I didn't change the bank account registered at these utility companies, water, utility, electricity and the gas and telephone. Yeah. All right. So what happened is, so I didn't pay 3 months, right? And then let's say the total amount is actually $100. So this utility company called me many times, but I was absent. Then they decided to sell this $100 to factoring companies. Yeah, that means actually this $100 is actually the amount payable. Yeah, for me, amount receivable for them, right? So they sell this $100 to factoring companies. And the sell means actually these utility companies, water, gas, telephone, electricity, they get the $80, right? And then so utility company get the $80, sell my account receivable to factoring company, and then factoring company pay $80 to these utility companies. The factoring company is actually specialized in collecting the payable, the amount payable, account payable, or amount account receivable. So 3 months later, it's not utility company, but these factoring companies called me, send me letters and reminding me of payment of this. Yeah. Okay, this utility company didn't get $100, but they had $80, right? Which can be used to make a repayment to someone else, to buy electricity, to buy petrol, oil, gas. Yeah. And then these factoring companies get $20 as a commission, right? And then so so this means actually liquidity, availability of account payable or account receivable is very, very liquid. So many even so, which means sometimes company okay, your company is fine, but your partner company fails, so you cannot collect the money, right? And then maybe it takes maybe 10 years, right? So in that case, you can sell your account receivable to factoring companies, and then you get 80% of your debt, account payable, receivable. And then, so in this way, you can survive, right? And then factoring company later on recollect the money, my money, to the company which went into bankrupt. Yeah. So this is how factoring works. And then factoring is very, very popular now in Mexico. So if the legal framework is established, you can in Indonesia also use factoring as well. Okay, so this is the end of my lecture. Thank you very much. Please, Professor Fadi.
Okay, arigatou gozaimasu, Professor Masakazu Somea.
Thank you very much
for giving us such informative and interesting presentation. Well, guys, now come to the question and answer session. I would like to have 3 questions from the participant. Please write down in the chat message, or you can ask directly to Professor Somea. Okay, guys, anyone? Or you can write in Indonesia. I will translate it to Professor Somea. Okay, Professor, while waiting the participant to give your some question, so I have one question about the SME. So the subprime mortgage in Indonesia, the subprime mortgage in 2007 and 2008 got impact in Indonesia as well. but it did not have much impact like the developed countries. Yes. It is because some researchers give explanation. It is because the most private banks or commercial banks in Indonesia has founded SMEs and even micro enterprises. So can you explain or tell us about how about the case study in Japan?
Okay, subprime event didn't affect Japan too much. One of the reasons is actually Japanese banks are very, very conservative. You know, they didn't actually initiate, subprime loans. Yeah, so subprime loan was very, very popular in the United States, and then they actually expanded borrower basis. Yeah, usually those borrowers who have a very low credit score didn't have access to the loan, but a subprime lending opened the access to these low-income borrowers. So it's become very popular, but suddenly, the failure of some of the banks in terms of subprime, then it's become spread into all the United States and some European countries. Yeah, but because Japanese companies banks exposure to subprime financial product in United States was very limited. That's why actually the damage was minimum. All right, these subprime loans are very popular and then only available in United States, but many European banks invested. They bought these subprime loans. So that's why actually when this crisis happened, some of the European company had the damage, but because Japanese banks are very, very well conservative, so they didn't buy it, so they didn't suffer. But okay, some people say, hey, that's why banks should be very conservative. Yes, maybe some part is right, but but discussion is not complete without looking at how much profit Japanese banks missed not to buy these subprime loans. So I'm not sure. If you look at the damage, maybe Japanese banks are okay, but if you look at the opportunity missed by the Japanese bank because they are very, very careful, very, very conservative. So for this opportunity missed, we cannot measure the amount. So perhaps overall conclusion is maybe a little bit between good and bad, I guess. Okay, Professor Fadi, I cannot hear you.
Sorry.
Yeah, it's okay.
Okay, we have one question from Rizky Catur. So he asking about it is hard to SME got the credit from bank or even investment because, as we know, SME is vulnerable or too risky for the lenders. So what is the preparation to the SME need to prepare in order to can be trusted as a good creditors?
Okay, very good questions. Yes, perhaps one thing that SME can do in order to get the loans from the commercial bank is actually improve financial statement. Yeah, and then maybe you follow international standard of financial reporting system, and then make a bookkeeping consistent to international standard, so that commercial bank can have a very good information, and then there is no information asymmetry. Yeah. Another one, perhaps the use of new financial products like a factoring, or sometimes you can ask credit guarantee system to get the loans. But as long as your business model is good, then the the biggest problem is a business model. And then if your business model is good, then it's a matter of communications. So you make your company transparent and then give lots of informations. Then that may be something that SME can do.
Okay, thank you, Professor Somaya. Is there any question? Okay, one more question from me, Professor.
Sure.
So, how about the non-performing loan for financing in SME in Japan? How the bank solve this problem besides using CGS? As we know that not all SME sectoral can have this privilege, CGS privilege, right?
Right.
Considering they don't have collateral, how to solve this problem?
Okay. Yeah, it's a very good question. And then perhaps not many countries encounter this non-performing loans. Yeah, and then we did around 1990s. We had a lot. I mean, banks had a lot of non-performing loans, and then all right. Some of the non-performing loan can be performing loans if liquidity is provided. But some of the non-performing some of the non-performing loans are really non-performing loans. In that case, you have to perhaps how can I say? You have to pay. Yeah. Perhaps what the Japanese banks did was they established consolidating institutions for bank loans, bank bad loans, non-performing loans. So what they did is actually many commercial banks sold their non-performing loan to that consolidating institutions. Yeah, and then maybe they sell maybe 30%, 40%, but still better than keeping non-performing loans. So and then this consolidating institution which buys bad loans from banks, they collected and then made a sort of structured financial products. Well, as long as loans are up and running, which means the company do not go into bankruptcy. If this consolidated institution forced them to pay back, the company goes into bankruptcy and then no repayment at all and no interest payment. But the banks only sold this bad loan to consolidating institutions. They are still up and running. So they put together all the bad loans and then make a one structured financial product and then sell to investors with high interest rate. Yeah. So that's how. But many of the non-performing loans are just underwritten. I mean, paid by commercial banks. That's what happened.
Thank you, Professor Somaya. Is there any question, guys? You can write it in Indonesia. Okay, last question, Professor Somaya, about the soft information, right, that you mentioned before. So soft information is manipulable, as we know. So how the bank to manage this kind of soft information?
I think Professor Fadi, that's a very, very good question. Perhaps we have to ask. Yeah. The kind of internal rules in commercial bank is very, very restrictive. So that's force relationship officers to behave well. Yeah, and then maybe some of the slide mentioned training. I didn't mention, but the slide mentioned perhaps training for these relationship officers to have a to improve skills to analyze the company by visiting, not based upon the hard informations. So, but it's very, very, as you said, it depends on the countries. Maybe some countries it works very well. In some countries, maybe it not really work very well. Yeah, but at least there's an option to for two options: transaction lending and the relationship lending. Then it's gonna open the credit to SMEs. But that's very good question. We have to think about it.
Yeah. Okay. Thank you, Professor Somya. Well, guys, because our time is up, so we finally come to the end of this seminar. Before I close the seminar, I would like to take the conclusion from what the Professor Somya has presented. Point one, according to Professor Somya, there are 4 important points of SME in financing. Size, about size, and then the second one, the lack of internal funding, and then informational opacines, or created information asymmetric. Then the last one, the large size of informal sector is often associated with the high cost of formality. And the second point is based on Professor Somya's slide. There are many possible reasons why an SME may not be able to get a financing from the financial system. One is lack of project with a positive net present value that will justify the bank financing. The second one, lack of management skill. The third one is lack of management's interest in expanding their businesses. The fourth one is natural limits to the size of enterprise or optimal size for industry. Fifth, lack of collateral that the banks require to give them a loan. Sixth, complex application procedure to get a loan. Seventh, interest rate that the banks are charging them are too high. The last one, the size and maturity of the loan are not sufficient to meet their needs. And then the third point, based on Professor Somya, the goal is not finance for every SME. That is why directed lending and subsidized interest rate for SMEs are not the way to go. The purpose is to create an enabling environment. By that, we mean an environment that will facilitate financial institution lending to SMEs that have valid financing needs despite that obstacles such as informational asymmetric that we discussed in the second point. The fourth one, according to Professor Somya, lending technology is a unique combination because there are 4 points. One, primary information source. The second is screening. The third one is loan contract. And the last one is monitoring strategy mechanism. And the last point is Professor Somya mentioned some type of lending technology. The first one is transaction lending. Second one is using financial statement lending, and then using credit scoring, and then the relationship lending based on the soft information about the borrower. And then the fifth point is cash flow based lending. And then the last one is using CGS, credit guarantees schemes. Okay, I would like to thanks to the speaker, Professor Somya, for the informative and interesting presentation, and all the participants for the very active participant. Yeah, we know that 2 participants active in here. And finally, give the online applause for the speaker and for you all. Thank you very much, Professor Somya.
Thank you very much.
Wassalamualaikum warahmatullahi wabarakatuh.
Terima kasih.
Yeah, arigatou
Bye-bye.
gozaimasu.